Looking at your research, we looked over it, and I've got to say, it's all about sea change. I'm a sailor, and I know, and I have been for years, sea change, it can be a good thing and it can be a bad thing. Tell us about your thinking here.
Well, the point is that a sea change is something more fundamental than a minor cyclical fluctuation. It suggests a total transformation that will be somewhat long-lasting. And the
doesn't happen often.
And by definition, it doesn't happen often. But the point of the memo was that ever since the global financial crisis, the Fed put in emergency measures to rescue the economy and the markets, and they worked, but they were continued for a long time. Zero rates were the rule for 7 years, which I was stunned to find out when I researched it. And that kind of conditioned the markets to depend on ultra low rates, which was unrealistic. And then when they tried in 16, 17, 18 to raise rates, they got a lot of pushback. The fourth quarter of 18, you may recall, they took the 10-year to the Fed funds rate hit 3.25, and the fourth quarter of 18 was the worst fourth quarter in history as a consequence. So they were in a low return trap. Mm-hmm. And lenders likewise were in a low return trap. You know, I gave a speech for 8 years entitled Investing in a Low Return World, and it wasn't fun. Mm-hmm. Because how do you get a good return in a low return world? You either you either accept the low returns or you take on more risk to try to get a high return, and that may not be a great idea either. So there is no easy out, and we labored in the wilderness for a decade with low yields prevalent, and I think that that's not going to be the case to the same degree going forward.
It's not just low yields not being prevalent as being part of this sea change. What else do you see? Which, by the way, you argue this is only the third sea change you've seen in your career.
Yes, well, in the 70s, I saw the adoption of risk return thinking. Before that, a professional money manager, a fiduciary, the rules were this is okay to do, this is not okay to do. But with the advent of high yield bond issuance in the late 70s, people started to think, well, it may be risky, but I'm well paid to do it, so I'm going to do it. It makes sense. And that has become the rule and been the rule ever since. And I think that was a very good change. Most of the things that we see in the financial world today are the result of that calculus. Then in the early 80s, of course, to fight the inflation that was prevalent in the U.S., reaching mid-teens, Volcker took the Fed funds rate to 20, and that eventually killed off inflation and inflationary expectations. It kind of killed the economy in the process. But then, I had a loan outstanding from a bank in 80, and I got a slip saying the rate is now 22.25. 40 years later, I was able to borrow money at 2.25. So we had a 2,000 basis point decline in interest rates, and that was a major event. That was probably the biggest single financial event of the last half century, but nobody talks about it.
Howard, one thing I want to ask you, and it's in your research note, you talk about, when you see both rising asset values as well as a very low rate environment and what that does in terms of leverage. Tell us how that maybe creates, ultimately, I'm assuming, opportunities for you.
Ultimately, we hope. But, look, the government doesn't make anything. It doesn't add to GDP. It doesn't create anything. All it does is takes money in and puts money out. And policy benefits some and hurts others. So the policies of the last 14 years that I'm talking about benefited asset owners mm-hmm. and borrowers and penalized lenders and savers. But it was a boon for anybody who owned assets and for anybody who borrowed. And what about people who did both, who owned assets on borrowed money? A double bonanza. The problem is that the success of that depends somewhat on the persistence of that environment. And number two, environments that produce high profits usually encourage people to push the limits further and to go out and do riskier things because of the absence of risk aversion, which usually ends up badly. We've gone through an easy period for the last 14 years.
It's going to be different now.
And I believe that the coming period will be a harder period. Not a cataclysm, not a depression, but I think that people don't recognize that the last 14 years have been unusually easy, and that I believe that the coming years will not be similarly easy.
So it opens up the question about where specifically you would see opportunities for distressed debt in 2023 and beyond.
Sure. Well, first of all, I think we might see some. And that would be a change. In the very benevolent environment that we had over that period, it was very hard to default. It was very hard to go bankrupt. In fact, you had to have something seriously wrong to do that, because most companies that just burned money every quarter could borrow more.
We just talked about the biotech sector, that it's been an easy 10 years for them.
Yes.
Not so more.
But when risk aversion rears its head and you go in to get more, now somebody might say, you know what, you're just burning money, we're not going to give you any more.
So where, and I think it was November, you talked with our team and you said, great bargains coming as recession looms. So where specifically? I know we've been, is it energy? Is it real estate? Where is it?
Well, I never get down to that granular level, and our activities are kind of not planned. We're opportunistic. When something pops up, and some company has to roll over its debt and suddenly is unable, we mobilize. The point is, we're not laying plans in advance.
Well, do we take something like Elon Musk and all the debt he took on for Twitter? Do we take a Bed Bath & Beyond, another retailer falling to the wayside? I'm trying to think.
Party City.
I feel like,
I mean, you could name any crypto firm over the last 6 weeks.
Are these signs that are playing to what you're talking about?
Well, let me just say, without getting too specific, which I always try to avoid.
I know, sorry.
That's okay. That our mantra is good company, bad balance sheet. A good company that has gotten over-levered, and that leverage level has turned out to be excessive for the environment that has unfolded, you can fix that by delevering the company. Maybe you take it through a bankruptcy in which you reject a lot of debt. But it's easy to, if you can delever a good company, it goes on to success, or certainly it's reinstated. Bad companies are hard to fix, as opposed to a good company with bad balance sheet. So you propose the list. You figure out which companies on that list are important to stay in business for the next 10 years.
You mentioned a couple retailers, Carol, which makes me question if there are any industries or sectors you would avoid.
Historically, we're okay with retail.
Okay.
Although one has to be cognizant of the changing business model. We're mostly active in what I would call the basic industries, the traditional industries, the ones with assets.
Like energy?
Like energy, yes. Manufacturing, distribution, transportation, even retail. Under the right circumstances. Where we historically have not been active has been, for example, technology, because there you need a higher level of expertise with regard to the subject matter.
Right.
Intellectual property, style, fashion, things like that.
This environment, this sea change, we only have about 30 seconds left. How long does it stay with us, in your view? Because as you say, these don't happen a lot, but they do stick around.
I don't make forecasts, and I don't believe forecasts, especially my own. Having said that, I'm not talking about 6 months or a year, and I don't ever venture a thought to 10 years. So I would say something in between. But I mean, this is material, and I would say a few or several years.
Well, and I do feel like it mirrors some of the conversations we've had, that this low-rate environment, we have a generation who's never seen anything but.
Right.
Could we see a fourth sea change in your career?
I hope I live long enough.
We hope you do, too.